A tax-free savings account, TFSA, is another popular and flexible savings vehicle in Canada, but it works differently from an RRSP. Here's an overview of how it works. As the name suggests, the main advantage of a TFSA is that any earnings, interest, dividends, capital gains, accumulate tax-free within the account. You do not pay tax on the growth, even when you withdraw it. The Canadian government sets annual contribution limits for the TFSA. For 2024, the annual contribution limit is $6,500. The contribution limit is cumulative, meaning if you don't use your full contribution room in a given year, it carries forward indefinitely. For example, if you contribute $4,000 in 2024, you can contribute an additional $9,000 in 2025, combining unused room from 2024 and the new limit for 2025. Over the years, the government has adjusted the contribution limits. The total TFSA contribution room you have depends on the years you were eligible for the account and how much you've already contributed. Withdrawals from a TFSA are tax-free, and unlike an RRSP, there is no tax impact when you take money out. One of the unique features of a TFSA is that withdrawn amounts are added back to your contribution room in the following year. For example, if you withdraw $5,000 in 2024, you can contribute an additional $5,000 in 2025 on top of your regular annual contribution limit. Unlike an RRSP, which has a contribution deadline in March for the previous year, the TFSA contribution limit is tied to the calendar year. You can contribute any time within the year until the limit for that year is reached. You can hold a wide variety of investments in a TFSA, including stocks, bonds, mutual funds, ETFs, and GICs. The same investment options available in other accounts are available here, and the earnings from these investments are what grow tax-free. Any Canadian resident who is 18 years or older with a valid SIN can open a TFSA. There is no age limit for contributing to a TFSA, meaning individuals who are retired can still contribute if they have contribution room. The overall benefits for a TFSA are tax-free withdrawals. You can withdraw money whenever you need it without paying tax, which makes the TFSA a highly flexible savings tool. Ideal for short or long-term goals. You can use a TFSA for a variety of purposes, whether saving for retirement, an emergency fund, buying a home, or even funding an education. No impact on federal benefits. Unlike RRSP withdrawals, TFSA withdrawals do not impact your eligibility for federal benefits such as old age security or the guaranteed income supplement. Cumulative contribution room. Any unused room carries forward, allowing you to contribute more in future years if you didn't use your full limit. The drawbacks of a TFSA are no immediate tax deductions. Unlike an RRSP, contributions to a TFSA are not tax deductible. You don't get a tax break up front, but the benefit is the tax-free growth and withdrawals. Contribution limits. You can only contribute a set amount each year. Over-contributing results in a penalty tax, 1% per month on the excess amount. Here's an example of how a TFSA works. Imagine you contribute $6,500 in 2024, and it grows to $10,000 by the end of the year. If you withdraw the $10,000 in 2025, that amount comes out tax-free. Moreover, in 2025, your contribution limit will be $6,500 for that year, plus the $10,000 you withdrew from the previous year, allowing you to contribute more. In summary, The TFSA is a highly flexible, tax-efficient savings and investment account available to Canadian residents. While there are annual contribution limits and no upfront tax deductions like an RRSP, the advantage lies in tax-free growth and tax-free withdrawals. This makes the TFSA ideal for both short-term savings, like an emergency fund, and long-term savings, like retirement.